Hi, my name is Yasha and I help young men invest in the stock market. So today we are going to analyze this extremely famous company called MasterCard Incorporated with the stock ticker MA. This is very famous financial company. You might have credit card from them. So I decided, okay, let's take a look at it together and see whether we should also add it to our own portfolio or not, okay? Now, as always, we are going to analyze MasterCard using this little Canva presentation that I have right now here. So let's begin. First, why should you even listen to me? My name is Yasha and as you know, I help young men invest in the stock market. So when you have more trust for me, click the first link in the description. Now let's begin with the actual analysis. This is going to be very simple, beginner, quick, straightforward, beginner friendly. That's what I wanted to say, without wasting time. So let's begin, okay? Generally, as a beginner, you should care about the following things whenever you analyze a stock, okay? You should care about chart, profit, debt, money on the bank account, value, and price. Now here you have some quick facts about MasterCard. So this is basically a financial services company that was founded in 1966, and you might have their credit card because they provide credit cards. It's that simple. Now, first of all, I want to tell you here something. Pay attention to when the company is founded, okay? Because the older the company is, the more time tested it is, okay? For example, if you have some IT startup that was founded last week or last year, let's say, there are high chances that they might not be the best option to invest into because you don't know how good the management is whenever it comes to some crises, okay? For example, in Corona crisis, let's say, or in 2008 crisis when the stock market crashed, many companies didn't survive because they were either too young or the management was incompetent, okay? That's why whenever you have companies, try to see when they were established because as a rule of thumb, the older they are, the more crises they survived, the more crashes they survived. And if they are still here right now today, then that's a high chance that the management is good, you know. So that's important here. Now let's go to the chart because that's how you analyze the chart, okay, usually. Now, chart has the following instruction. Chart has to grow for all 10 years. Now, what exactly does that mean? That means that I will first of all draw a little exponential growing line, kinda like that. And we are going to compare the actual stock price chart, which is here the orange line, with this black line that grows, you know. And preferably they should follow each other because why is that important? We want to invest in stocks that are growing. It's that simple. We want to invest in companies that are growing, that are expanding the business, that are profitable. That's why we check the chart, okay? Now, let's take a look here. Does the chart, which is the orange line, does it follow the black exponential line? Yes, it does. It does follow it quite well. So, the chart is good to go. Now we come to the profit. And for profit, we have the same instruction, okay? Profit has to be in plus and it has to grow. Now, as I told you, same as with the chart, we will first of all draw a little exponential line, kinda like that. And then we are going to compare the profit chart with this growing line, okay? Now, does the profit grow? Yes or not? Yes, it grows. You can see that it follows that line quite well. So profit is also good to go. It's growing, it's in plus, it follows the exponential line. This is what we want to see. Now we come to the debt, and instruction tells us that debt has to be low. I don't know what's with my mouse. Debt has to be low and preferably it should also decrease through the years, okay? Now here we have exactly the opposite. Here we have the growing debt, which is a bit concerning because when you think about it, if you have more and more debt as a private person, okay, if you have more and more debt, it's harder and harder to get out of it, you know. So the more debt you have, the harder it is to go out, you know. And the same thing is with the companies, the same concept, okay? The more debt they have, the longer they will need to repay it back, the more profit they will have to generate to be able to repay that debt and so on and so on. So that's why we have here a rule of thumb. Debt has to be low and it has to also decrease through the years, okay? Now here we unfortunately have the opposite. So we will mark that as a no-go as well, okay? And now we come to the money, and with the money we literally mean how much money do they have on bank account, okay? For example, you have right now on your own bank account around $100 or $200, for example. This is the same money that we measure also here for MasterCard. We measure how much money they have on their bank account, because this is important whenever something unexpected happens, you know, maybe some crisis, maybe some scandal, maybe, I don't know, MasterCard was accused of some frauds or something, and then the stock drops and MasterCard has to repay some unexpected costs, okay? That's why it's important that they have money on the bank account. Same as you. For example, if you need to pay something real quick and if you don't have money, you will start to panic. Same companies, okay? If they don't have money to cover something, they will start to panic. Now, do they have more money than the costs? Because this is what we want to see generally on the bank account. Yes, bro, you are smart, use your brain. They have plus $10 billion on their bank account. Now, this is amazing because, as I told you, if something unexpected happens, they have a bit of a safety, you know, because they have $10 billion. It's more than enough to cover something unexpected, okay? So money is also good to go. Now we come to the value, and as investors, we want to invest in stocks that are undervalued, okay? Now here you have the instruction. Now we measure valuation by two little things. We measure it by P/E ratio and intrinsic value. Now, if you are a complete beginner, obviously this might sound a bit complicated for you, but as a rule of thumb, just follow the framework here and you should be fine, okay? P/E ratio should always be lower than 15, as you can see right now here, and intrinsic value should be higher than the current stock price. Those are the two rules that are accepted across the stock market, and you should follow them as well, okay? Now, P/E ratio of MasterCard is currently 34, which is 2 times higher than 15, let's say. So in terms of the P/E ratio, MasterCard is actually 2 times more overvalued, okay? Now let's come to the intrinsic value, and this might sound a bit complicated, so I want your full attention right now here. Now, intrinsic value tells us the value that the company should have at this exact moment. Should have, okay? This is important because based on some calculations, we calculate the fair value that the company should have, and in our case, MasterCard should have $300 right now, okay? The stock price should be $300, but the actual stock price at this exact moment is $433. So the actual stock price is by $130 higher than it should have been. You know what I mean? So basically, intrinsic value tells us, okay, what should be the price at this exact moment, and then we have the current price, okay? And in order for stock to be undervalued, the intrinsic value should be higher than the current price. But here we have exactly the opposite. Here, the current price is actually by 130 higher than intrinsic value. So it's 130 higher than it should have been. You know what I mean? So that's why the stock is also with intrinsic value overvalued, okay? Now P/E ratio, as a quick fact, P/E ratio is basically calculated how much dollars do you need to spend for $1 of earning for MasterCard, okay? In our case here, we should spend $34 to get $1 of earning per stock, okay? Now, this is usually used to measure if the stock is overvalued or undervalued in comparison to competition and also to the whole financial sector, okay? This is what we measure with that, okay? And now we come to the price. And as a rule of thumb, you should consider that the stock price should be lower than 150 euros. Now, that's for me, I'm from Europe, I use euros, okay? You are from America, so you probably use dollars, obviously. So for you, it's going to be $150. Now, is the price below 150? No, it's not. At the moment of recording, it was $433, which is well above, like almost 3 times higher than 150. So obviously stock is overpriced. Now, why exactly 150? This is just something that I came up with because, in my opinion, stocks that are over 150 euros or dollars are a bit overpriced, and I don't want to spend too much money on the stocks. Okay, I want to spend it on cheap stocks that grow potentially, you know, that have potential to grow, that pay dividends, because cash flow is more important. Okay, that's just my perspective. Now let's come to the final evaluation, where we are going to just summarize everything that we found out about the company so far. Okay, now here I will just ask myself the questions and then give the answers. It's that simple. Now, does the chart grow exponentially? Yes, it does. If you don't believe me, go a few minutes back and watch the whole video again. Does the profit grow exponentially? Yes, it does. Does the debt decrease through the years? No, quite the opposite. It increases through the years. Now, do they have money on the bank account? Yes, they do. They have, I think, like $10 billion. I'm not sure anymore. But yeah, they have money. We may analyze that. Is the stock undervalued? No, it's not, because both P2E and intrinsic value are higher than they should have been. And is the stock price below 150 euros or dollars for you? No, it's not. It's 430. So no, it's not. Now, should you buy or sell? In my opinion, I don't know, here it's a bit tricky question, okay? So everything that we found out about the stock so far tells us that we should buy it, because the company is growing. They are growing dividends. They have amazing profits. They have amazing reinvestments back. You know, like if I show you here on my screen right now more in-depth analysis, you will see that they are growing everywhere. Look, total revenue growing, gross profit growing, operating income growing, net income growing, net income margin growing. They are also, retained earnings are how much they reinvest back. They are growing. Return on equity, almost 160%. That's amazing, you know. As I told you, bro, the only thing that I don't like is that they have too much debt. They are overpriced in terms of the intrinsic value and P2E ratio, and the price is too high, you know. Because don't forget it, they had stock split. That's why the price is so low. Otherwise, if they wouldn't have the stock split, price would be right now around $1,000, which is way too much, bro. Especially as a complete beginner as you might be, this is too expensive stock, really. I know it's a famous company. I know that they are growing. It's a safe company, but for me, it's too expensive. It's too overpriced. I did the same mistake when I was analyzing, or when I was investing in Tesla back in the days, when I was just blindly buying the shares and thinking, okay, yeah, Tesla is a famous company, they will for sure grow, and now my stocks of Tesla are, I think, minus 30% or something. So even if it's a famous company, it doesn't mean that it's an amazing stock, you know. You need to do the analysis and then think about what do you want. So for me personally, I want cheap dividends, basically buying cheap stocks that are also good and that they pay dividends, so that I can have that monthly income in my bank account. This is what matters to me the most. And here with MasterCard, unfortunately, the stock is too expensive. They have way too much debt. So in my opinion, I wouldn't buy it, you know. It's an interesting company for sure. They are growing massively. It's a famous one. But nah, for me, I don't think that I would buy it. Now, if you want to know more about stock market investing, of course, I invite you to click the first link. I will teach you everything about it. Also, join me on this amazing journey to become a millionaire with the stocks. So click subscribe, do the hard work, bro, and see you on top of the world.